Tick, tock. The economy is likely to implode within 27 months. Martin North, John Adams, in the interest of the people. Hello, John. Good to see you again.
Hello, sir. How are you going today?
Very good. So the clock is ticking.
The clock is ticking. So unfortunately, this is perhaps a more sober episode because one of the things I've been looking for in tracking this economic crisis is the most accurate predictor of something bad happening in the United States. So a lot of viewers would have seen, particularly in some of the American videos, about this talk about an inverted yield curve. Now, there's been a lot of work done by US officials, by people on Wall Street about the yield curve and its ability to predict a economic recession coming. So I've been looking at this for quite a while, thinking that if there was going to be a global shock that would impact Australia, it'd largely either be from China, the US, or Europe. So obviously the US is still the largest economy of the world. So if they go into recession, given how big our debt bubble is, we will be adversely impacted. So there's been a lot of talk in the last few months on the internet that the yield curve has already inverted. And what that talk was about, for example, the inversion of the 1 year and the 5 year yield, or the 2 year and the 5 year yield.
So John, I know that some people have been saying that there's been an inverted yield curve already, but I think that there's a very significant difference between that early talk and what's happening now. So what's the really critical inversion we need to follow?
Yes. So the US Federal Reserve, so the US Central Bank, has said through its own research, and there was a paper put out a couple of years ago that said that the most accurate predictor of a recession is the inversion of the 1 to 10 yield curve. So other parts of the yield curve, say the 1 to 2 or the 2 year to the 5 year, these inversions took place about 2-3 months ago, and there has been a bit of a song and dance about these, but I've sort of held my powder dry and waiting for the 1 to 10, which the government itself said is the most accurate predictor. So it inverted. So tonight is Friday. It inverted Saturday morning Australian time last week. So in the Friday trading. So and it has remained inverted throughout the week. This predictor for the last 7 recessions in America, going back to 1969, it has not failed. So when this inverts, it is, imagine you have a bomb, you have a timer, you have a detonator. Well, the timer has been turned on, and unlike the movies where you can turn the timer off with a few seconds to go, for the last 40 years, once this timer goes on, you can't turn it off.
Right. So just for people who may not be as au fait about yield curves and things, right? The yield curve is an indication of expected future interest rates, right?
Yes.
And bond yields are connected with that directly. So when the inversion happens, what we're saying is that future interest rates are going to be lower than near-term interest rates.
Yes.
Right? And what that does is to then say there's a reason for that, and the reason is essentially that the market now thinks that the future outlook is deteriorating.
Yes, in terms of the short-term outlook.
Correct.
Yes.
Yeah. So what that then says is it's been a trigger for a collapse of some sort.
Yes.
And it's been consistently a trigger over the last 40 years. Yep.
Exactly. So we have. What I actually did some months ago was I actually downloaded all of the data for the 1 year bonds, for the 10 year bonds, and I looked at going back to the early 60s and mapped out every recession, and then I mapped out the precise first time that it actually inverted, and then calculated the time difference between when it inverted and when did the recession start. So I have an article up on my website, adamseconomics.com. News.com ran a piece on Saturday about this, because I sort of had alerted them several months ago that this was likely to be an event. So if people want to read the full column, they can go and have a look. But we're going to go through the last 7 recessions because based on these last 7, the recession could come either 3 months, which happened on one occasion, or it extended up to 27 months.
So, John, you mentioned that there were multiple times when a yield curve inversion led to recessions. I think it would be quite good just to go through some of those in a little bit more detail, just so people can understand that actually this is real.
So here's this work that I've done independently, and basically I've gone through the last 7 recessions. So the recession of 69, 73, 74, 1980, 1981, 1990, 2001, which was the dot-com crash, and the global financial crisis 2008. Second column is the first date of the inversion. So this is basically my own calculations of when did the 1-year yield curve go higher than the 10-year yield in terms of the interest rates. And then the last column is what is the time difference. So basically, from the date of inversion to the first quarter of negative economic growth in 1969 was 21 months. Second recession was 3 months, 19, 6, 20, 27, 24. So even with even though Lehman Brothers went under in September of 2008, the first date of inversion was actually late 2005. So and then obviously when you think about the previous one, which was 27 months, 1998, 2001. So could be very long. So because some people are saying it's 2019, 2020. Well, in theory, it could take to 2021 for these things to fully play out in the US context. But we do have some examples of things happening at a much shorter time frame than 2 years. Now some people have done a little bit of work about the Australian yield curve. It doesn't have the same predictive powers, but the one that the world markets focus on is this one, and the 1 to 10 turned on. And obviously, according to the work I've done here, we have 90 days to 2.25 years.
And the chart that you also showed, I think is really interesting because it actually highlights that these can be quite deep drops when they happen, right?
Yes.
And also quite frequent drops.
Yes.
Which surprised me, actually. I didn't realise there had been so many, dips over that period.
Yes. I mean, like particularly in the 1970s, but when you had stagflation, I mean, you had some very profound inversions of the yield curve during that period when we had stagflation. And I know in a previous video you've talked about stagflation potentially coming. The US and the Europeans have talked about it. It's actually one of my 6 scenarios of how this may play out. So some people, now that it's inverted, people look for how long does it invert for, how deep are the inversions, do we read anything into that? So that may tell us something about what US conditions may look like in the next couple of years. But everyone should be awake to that this is not just a theoretical conversation anymore. From here on in, there can be no question that the crisis is coming. Going back to the 1950s, there's only been one false positive, and that was in 1965. So the yield curve inverted for 3 days in 1965, and that led to a severe slowdown, but economic growth was still technically positive. So no technical recession of 2 consecutive quarters of negative growth. But other than 1965, it inverted in the 50s, it inverted in the late 60s, and since the late 60s, when it inverts, it has not failed to deliver. And I would say that you look at the American economy today, heavily in debt, government, heavily indebted households, heavily indebted corporates. The American economy was much healthier in the 1960s. So the question is, could we see a false positive? Could we see a slowdown with no recession, given how indebted the Americans are, given how the poor quality of the corporate bonds? I mean, 40% of the bonds, the 40% of the corporate debt is junk bonds, so it's very low quality debt. It is unlikely that now that we have this inversion, we're going to avoid a US recession, and that US recession could come this year or could technically come in 2021. But I think everyone should be prepared for a American recession, and that's going to cascade throughout the global financial system. A lot of experts have said that this is likely to be worse than the global financial crisis because of the quantum of debt, which is about $80 trillion more compared to 2007. You have a lot of derivatives, you have a lot of risky, globally systemic important banks like Deutsche Bank, like Commerzbank and a few others. So we have enormous debt, enormous risk, and we have a signal saying that the Americans are headed towards recession, and that can only spell disaster for the global economy.
And I guess the question I've got is, we know that there are risks in our local economy already, right? There are already indicators of slowing GDP, high debt, and all those things here, right? So we could actually have a crisis of our own making.
Yes.
Or we could have a crisis created by the US going off the boil and then creating a global crisis that gets swept up. So we've actually got two potential scenarios, right? Both of which we're monitoring quite actively.
Yes. So what I do know for a fact that policymakers and people in the ALP, so the ALP are getting ready to come into government. The ALP are thinking about there will be a global shock during their term of government. So I have some sources who met directly with some senior shadow ministers, and they had some very open discussions about this. So for 200 years, or for more than 200 years, every economic crisis that Australia has gone through, it has started overseas. So this is the expectation of everyone now. And even in my sort of quite famous now debate on Your Money, Christopher Joy at the end basically said that if the global recession comes, his words, all bets are off. So even though some people in the establishment are saying that at this time there is nothing to be necessarily worried about, his words, all bets are off if the global recession comes. We have the signals to say that the global recession comes. But what you and I and Eddie Hobbs did last week was to put out a different thesis, which is actually quite radical in the context of Australian history, that we may. So if the US goes in recession in, say, 2 years, well, we could go through a domestic collapse of some sort with our housing market and with our housing with the household debt bubble before the Americans go. And this is exactly what happened with Ireland. The Irish housing market collapsed in 2007, and independent of Lehman Brothers or Bear Stearns, it was always going to collapse. But then when Lehman Brothers happened, I mean, that was like a second tsunami on top of the initial tsunami that the Irish were going through. So it could likely be that if we go first, and then the Americans go, well, we could see two tsunamis hit the economy, and it could be a double Armageddon.
Armageddon squared. So the point there is that in this level of complexity that we're talking about, right, there are lots of different risks out there, and the interplay of those risks are not necessarily totally clear, but nevertheless the end result, whichever way you play it, looks as though there's significant downside risk for the local economy. Exactly.
So people in the bureaucracy, people in the ALP are expecting a economic crisis in the next 2 years. So this is not Adams and North making this stuff up, but everyone is openly saying, even in my debate, if the global recession happens, we are poorly prepared. And this is why I have been for several years banging on the doors of parliamentarians and saying that every economic crisis we have, Australians are complacent, she'll be right, we are not prepared, and then when it whacks us, thing is, look, we get wiped out in the process. So initially, and even up till last year, Armageddon was always for me the global shock, and we're not prepared because everyone's heavily in debt, the policymakers are not ready, and we're going to get swept through. But it's only in the last probably 2 months where I've started to think, well, the global shock is still on the table, but there could be a sort of we could go first. We could be the shock that blows up the world. But if we're not, well, we know that the global shock is coming, and a lot of households who are heavily in debt are very unlikely to unwind their positions at this stage.
Okay, so just sort of to summarise then, it might be a local crisis. It might be an international trigger. But either way, it looks as though the writing is firmly on the wall now. So people have been warned.
People have been warned.
John, thank you very much.
Thank you.
Martin North, John Adams, in the interest of the people. See you next time.